All right, my friends, so now let's talk about the 7 best corporate bonds to buy and hold for 2019, according to U.S. News Money. And then we're going to look at the credit rating, and we'll see an example of what they're paying right now. This will be kind of wrap up our synopsis of the bond market and what you need to be prepared for. All right, so here's Rebecca Lake, contributor 2018, so a couple months ago, but it won't matter. Everything will be the same. Actually, it'll be probably worse than what we're showing here because the rates have actually gone down. All right, so 7 best corporate bonds to buy and hold for 2019. There's a few on one page. I hate when they do, we got to click. All right, and they show GameStop, which is kind of weird. All right, so experts recommend shorter duration bonds. I don't. If you're going to buy, and I don't recommend any bonds, but I do recommend longer duration CDs for sure. And I did a video a few days ago where I showed you about what happens, why you should buy a longer term CD than a short term CD, even if you have to get out of it and pay a 3 to 6 month interest penalty in order to reinvest at a higher premium, a higher rate if the rates do go up. That's the way to do it. Bonds are different, but I still, if you're going to, the whole point about owning a bond is to hold it to maturity. It's not to get a capital gain because you're not going to get any. And on top of that, if you're trying for capital appreciation, where should you try better? In stocks. So anyway. All right, so while stocks have taken the brunt, let me make this a little bit bigger. While stocks have taken the brunt lately, by the way, it's a new Mac Air. I love it. As I'm getting used to it, I'm a fan. It's taken a long time to get acclimated to it because the Chrome is so easy to use, but I'm starting to dig this for sure. All right, well, stocks have taken the brunt lately, and the market's downturn. Corporate bonds are also seeing the effects. With the market worried about an economic slowdown and the higher interest rates that have occurred over the last year or so, corporate bond spreads have started to widen. Says Timothy Womack, Director of Fixed Income at Creative Planning. And so Creative Planning, by the way, is where Tony Robbins, I think he's still one of their evangelist, whatever it's called, over there, which I kind of find funny. Jonathan Clements, all right, Jane Bryant Quinn, they were all on the board as of a year ago, and I imagine they still are now, unless they've been canned, I don't know. But I did an article. My best performing article on my blog is why Tony Robbins is wrong on fees, where I take to task all these guys. So because they talk about how fees are the devil's choice, but then they totally they overlook that creative planning charges fees, and not low fees either, pretty significant fees. And I just I chuckle. I said, how can you say fees are bad over here, but they're okay over here? I mean, look, I got no problem paying fees, but make it apples to apples, man. I mean, come on, let's, jeez. All right, anyway, with a yield curve relatively flat and uncertainty about continued rate hikes looming, maybe I'll do another video because it's been over a year and just look at creative planning and see if they're actually exposing their own fees on their website. Because I did that last time, and you had to go to their SEC, what's called ADV form, SEC/ADV, and you really had to dive in deep to get a clue of their fees. That will be part of my I think I'm going to do that. All right. With the yield curve relatively flat and uncertainty about continued rates looming, so the rate hikes are gone. No one's indicating that. Now, Powell and the rest of the boys at the Fed could always just surprise everybody with increased rate hikes. The jobs report in February, I kind of think that put that on the skid. They're not going to happen. So right now we got a yield curve relatively flat, 2.4 on the, I think it's a 6-month T-bill yield, and 3% on the 30-year. So 2.4 in 6 months, 3% on 30-year. That's a pretty flat yield curve. When looking for corporate bonds in 2019, consider making these 7 buy and hold plays. Notice they said buy and hold. So we're going to talk about this. Allegiant assigned a BB minus rating by Standard & Poor's. So let's see what a BB minus, because again, I don't know off the top of my head. I got to look at the thing. And so we're going to Wikipedia, and there's Standard & Poor's. BB minus is right there, which is non-investment grade speculative. So that is a junk bond, BB minus right there. It's the middle of the road for non-investment grade speculative. Not highly speculative, but certainly junk bond. Let's see what old Allegiant, whatever it's called. I wonder what they're talking about, their current rates, huh? All right, so the current yield to maturity, which represents the total return expected when the bond is held to maturity, is 4.5%. All right, so that's a junk bond, yielding 4.5%. going back to the whole genesis of why I'm doing this tutorial series, is a guy said he could get investment grade bonds paying 5 to 7% at discounts. If you're getting a junk bond at 4.5%, the absurdity of that statement boggles my mind. Now, look, man, just for the record, show me, call up your broker, Ed Jones, Creative Planning, whoever it is. Say, for fun, for giggles. Hey, guy, this is Josh Scanlon. You remember me? Yeah, I know because you never call me. But I'm looking for corporate bonds, highly rated, investment grade. It doesn't have to be highly rated, just investment grade corporate bonds. Let's say a 12-year maturity, 5 to 7%, and I only want discounts. See how long it takes for that guy to laugh on the phone and hang up on you. All right. All right. So here's Allegiant, which is, again, a speculative bond, i.e. a junk bond. It is paying 4.5%. There you go. All right, and what do they say the maturity is? The current yield maturity with stable outlook. Okay, so I'm not sure what the term on that bond is. It doesn't say. All right, so let's keep going. Now we got floating rate bonds are different. Floating rate bonds are. Well, I guess probably should talk about them. I got killed in the Hartford floating rate bond fund back in 2006 and 7. Imagine if you owned them as well, you did. All right, so some experts have less optimistic views for corporate bonds through 2019 and beyond. Either interest rates might be rising or the economy is entering into recession by next year. Says the associate professor at Tepper School of Business in Pittsburgh. I didn't realize one of those two things has to happen because neither is happening right now. Rising interest rates can lead negative returns, while recession could bring the possibility of increased defaults. Both scenarios are bad news for the corporate bond market. A floating rate fund such as FLOT is a good option if that holds true. It offers exposures to floating rate bonds with remaining maturities rating between 1 month and 5 years, making it useful for managing risk. And if I recall correctly, I'm not a huge fan of floating rate bonds simply because they're speculative, I think. If I recall, I'm almost positive they're speculative. Because what happens is they'll issue bonds like debts, like a car will have a showroom, the floor plan. They got to finance the floor plan to put those vehicles on their lot. That's what's called a floor plan. A lot of those are very speculative debts that a bank will issue. Then the bank will turn around and loan that money, and then we'll try to sell that in floating rates. And this is what a floating rate would be. And that's speculative. You can get high rates for it, but certainly not high quality investment grade. So GameStop, here's another one. GameStop is a company that's easy to dislike since it's a challenge in business. The company's Moody's credit rating is a high yield BA1, again, junk bond, with 2021 bonds at 6.75, sitting at 6.62% yield to worst. All right, so basically, even these not high credit quality. Well, let's go back. BA1 is Moody's, and we already talked about BA1. It's non-investment grade speculative. This guy's maturing in let's see, 2 years. You're getting 6 3/4 non-investment grade speculative, and that's what you're getting. 6.62 is yield to worst, which means it's trading at a little bit of a premium. So basically what's happening here is this bond is going to mature in 2021 at 6.75. Because the yield to worst is 6.62 as of writing. That means you're actually going to pay a premium for it. So you pay over the par value. So if the par is at 1,000, you'll probably pay 115 or something like that. Off the top of my head, I don't know. Can't do the calculation in my head. But if it's yielding yield to worst less than the coupon, which is 6.75, that means you're paying a premium. Again, going back to my guy, 5 to 7% discount, investment grade corporate bonds. It ain't happening. All right. Let's see. And the funny thing is, GameStop's cash flows will still be sufficient to handle current operating obligations, including debt maturities through 2020 and 2022. Yeah, that doesn't make me very comfortable there. Not my hard-earned money. Let's see. So we got ICANN Enterprises. You got current yields. With a BB plus S&P 500 rating, these bonds have grown more attractive in a low interest rate environment. Current yields range from 5.5% to 6% annually, depending on purchase price. Again, the premium or the discount. So bonds reaching maturity at 2020. The bond is callable, which scares a lot of potential investors away, but the yield to call is currently far better than the yield to maturity. So I'm not sure what yield to call. Okay, yield to call is what bonds yield if you buy and hold it until it's called away from you, i.e. the company refinance it. Let's see what a BB plus is an S&P, and again that's a jump bond again. So another jump bond is paying 5.5 to 6%, and it's going to mature in 2020. HSCA is a large company, strong footprint and excellent operations. 2022 and 2023 bonds are trading at near 5% yield to worst, but Spivey says their 2022 7.5 and 2023 5 and 7/8% bonds look interesting. All right, so again, you're getting a significant premium on these because they're trading near 5% yield to worst, and the coupon 7.5. They're trading much above par value for sure. So I mean, and I don't even know what the credit rating is on these guys for sure. Cash flows are on track and consistently exceed its operating obligations by more than $3 billion over the next 5 to 7 years, making its credit and debt position more optimistic. But again, so let's go back. If I bought this today, I get 5% yield to worst. And that's what you always got to look at. Yield to worst, yield to call, yield to maturity, those three things. Always want to start with yield to worst. What's the worst case scenario I can get on a bond? That's what you got to start with. Yield to worst and yield to maturity. If they're the same thing, that means the bond cannot be called from you, which means if you hold it to maturity, you know exactly what you're going to get as long as the issuer doesn't go bankrupt. Again, I'll do more whiteboard stuff on this. Yield to worst is all that matters, all right? Now, yield to call can matter too, but right now we just killed yield to worst. That's the worst case scenario. That's what you got to focus on, other than zero, which is it going bankrupt. So a 5% yield to worst, and it has a 7.5% coupon, that would mean the yield to maturity, if you bought it at issue, was 7.5%. Yield to maturity at issue is 7.5 because that's what the coupon. Yield to worst is way down here, which means the price is way up here. Huge premiums on that bond. That's pretty much all I want to do here on that. So, and they don't talk about with S&P rating of BBB, they don't even talk about the yields on these guys. All right, so these are some of the corporate bonds you can look. Don't buy these. I mean, do what you got to do. But the whole point about this was to prove the point. To prove the point that you're not getting bonds, corporate bonds, with any good investment grade credit quality. You're not getting them that's going to yield you much. It's just not happening. So if I could get, you got AA corporate bonds, what do we say? Trading at AA's or 3.105 or something like that. AA's, let's see here. Right there. 3.17. So if I could get a AA corporate bond, I don't even know what the maturity is, let's just say 5 years. At 3.17. And Navy Federal had a 17-month CD at 3.4. I'm taking a 17-month CD every day without question. Why would I want to? Because FDIC, well, in that case, NCUA insured CDs. It's 3.4 with AA rated, not likely to go kaput. But I'm getting a higher yield, the same tax scenario, because taxes are always ordinary income on CDs or bonds. And I have shorter term maturity, so I have more access to my cash quickly. And one's NCUA, if it had, the credit union version of FDIC, and one's completely could go bankrupt. I'm taking that credit union CD all day long, and you should too. It's just not enough value here to make this worth your risk. All right, as always, got questions on bonds, put them down below. I'm going to go down the whiteboard here in just a second and kind of draw you out some things. I actually think it's important to understand this as well, how this can work, and I'll use my whiteboard as opposed to my little thing here. All right, subscribe, share, smash, and state your comments down below. We'll see ya.